Well, good day, traders. A new week, new opportunities, and I want to look at some of those opportunities and those thematics that we've been playing through. And actually, it's the same thematics that we've been talking about for a couple of weeks, really. We're talking about oil prices. Yeah, they look like they've bottomed in the short term here. We're seeing a nice move up this morning, and that could be good for the Canadian dollar. We've actually looked at short trade opportunities in dollar CAD, but we want to see a bit more technical work going through there, and we'd probably look to add some of those short-term positions. That's something that we're looking at very closely. We're also very much focused on what's happening in the Brexit negotiations. Yeah, we haven't seen a vote of no confidence coming through. They haven't got the 48 letters being pushed through yet, but that may still transpire this week. If you look at implied volatility on a 1 week basis for cable, we've got implied vols above 15%. So if we put that through the Black-Scholes formula into the straddle and the implied expected move in either direction from current spot levels, then you're looking about 240 pips. So that's a decent move. The implied volatilities haven't subsided, they haven't fallen back. And if you want volatility, well then cable's still your proxy of everything that could potentially move in a fairly aggressive manner. So we still are looking at cable very closely and euro sterling and the sterling crosses, because implied vols are still elevated and traders are still expecting some decent moves coming through there as well. Of course, the EU budget negotiations playing through, and that's going to keep a lid on any kind of euro moves playing through as well. And I think the big thematic that played through in the back of the last week is the Fed changing their rhetoric. It really started on Wednesday through Jerome Powell having a much more nuanced statement. He was neutral, I believe, but the market was probably positioned for a slightly more hawkish rhetoric. But he's still very upbeat on the US economy, but he has changed his tune and he has acknowledge some of the risks that are happening in global markets. We obviously saw on Friday the likes of Robert Kaplan and also, more importantly, Mr. Clarida as well, who's the vice chair. And he's actually talked about where the neutral rate is, and he believes that there's probably one more rate hike until we get to that neutral rate. And being in the neutral rate feels about right for him. So you'd probably say that that feels somewhat dovish in the sense that the vice chair doesn't really see too much in the way of after a hike in December, we're going to be getting to a more neutral setting. And there's really no reason to be taking it past the neutral rate and getting into more restrictive policy settings. So I think that's really the key objective here, is this change, this slight change of rhetoric from key Federal Reserve members. Now, it's obviously not dovish in the sense that we should see an absolute collapse in the dollar, but they are becoming much more nuanced. They are recognising some of the vulnerabilities that are creeping through. So if we think about that in its entirety, let's have a look at some of the data flow that's coming through in the US, because a lot of the concerns have been around the interest rate sensitive parts of the economy, around housing, autos, for example, and even things like capital goods, ex-defence. They're very much in focus this week. We've got those capital good numbers coming through later in the week. We've got a lot of the housing metrics, building permits, existing home sales coming through. And of course, they'll be very much in focus as well. So further weakness playing through, and we probably could see some more continued weakness that we're seeing in the US dollar play through. Now, for me, the most important part of this is the interest rate expectations have been falling pretty sharply of late. In the interest rate market, the euro-dollar futures, we can see that the differential between the December 2018, December 2020 futures contract has really contracted down to 33 basis points. So we've got about in that period, in that 2-year period, we've got one rate hike being priced in and about a 40% chance or so of a second rate hike being priced in. And that's come in pretty sharply. We can go further out the curve and have a look at the interest rate differentials in 2020 into 2021, and actually see a small chance, or 2.5 basis point chance, of a cut coming through. So the market is saying, yeah, we might get one more rate hike. We'll certainly get a rate hike in December. We may even get one or even two more rate hikes after that. But then if we go further down the curve, there's a good chance we're going to see a policy mistake from the Federal Reserve. We may actually see them cutting rates, which of course is not a US dollar positive in any shape or capacity. So the market is at a stage where they are looking at late economic cycle trades. Being long materials, short the S&P, I think works well in that situation. But we're also seeing good buying across the US fixed income curve, and that's taking a lot of support out for the US dollar valuation. That's both on a nominal basis and also on a real basis, where if you adjust it for inflation expectations, you are seeing bond markets moving quite aggressively lower in terms of good buying coming across the curve, and most specifically centered in the 5 to 7 year bracket. So I think you have seen a change of rhetoric from the Fed. They've become a little bit more concerned about what they're seeing on the global economy and parts of the US economy, but there's still somewhat optimism about what's happening playing through. But we have seen a repricing of rates, and that's hit the US dollar. And certainly if you look at the euro dollar weekly chart, we can see price trading below those recent lows of 130, or the year-to-date low of 113.01. We had a nice move back up. The bulls have rejected those lows, and we've got to close back around 114.20 or so. And obviously, we'll have to see if we can see a higher high at the beginning of this week and playing through in euro dollar. That should take the broad US dollar complex down. We're obviously going to see what happens in dollar CNY, CNH. If that continues to find sellers, then we're probably going to see the Aussie dollar push nicely higher, despite what we've seen from comments from Mike Pence talking about trade and actually pushing back on some of this recent goodwill around that. And trade's another big key thematic that we're playing through as well. In terms of the Aussie dollar for the week, well, the market's expecting a 77-point move in either direction. If we look at the straddle, that seems about right. I don't see any need for big volatility from that. But my gut instinct at the moment, if we are going to see a little bit more goodwill coming out of the US dollar, then emerging markets could be a better place this week, and the Australian dollar should benefit from that. My long-term target, in terms of medium-term target, should I say, is around 74.50. That's the 38.2% retracement of the January sell-off. I think that would be a good place to look to fade moves into that situation. But on the start of the week, again, we're continuing to focus on what's happening in trade, what happens in oil prices with the rate hike expectations that built into the market, what's happening in the EU negotiations around Italy's debt situation, and of course what's happening in the Brexit scenario. So certainly some big macro thematics to continue playing around this week.